Hey everybody, this is Ryan Mallory and I'm going to do a stock market update for you today. It's been like a couple of weeks since I did my last one, but the market's been kind of boring to it. Not a lot of price action, not a lot of volume, but let's go ahead and get into this thing, see what we got to work with. S&P 500, it's up 6 out of the last 7 weeks. We've seen it sell off the last 2 days, but let's be honest, it's been pretty much the smallest of all time pullbacks, probably. It hasn't hardly pulled back at all. Instead, what we continue to see is the dip buyers, the algorithms, they keep buying in on every single dip to where even if the market does sell off big intraday, it rallies back hard before the close. We saw a little bit of selling on Tuesday, but that was quickly bought up the next day on pretty much no news. Now you still have a few drivers that is pushing the market higher on a headline basis. Of course, we got the Fed that's pumping money. They don't even have to talk about it. Everybody knows they're doing it. It's motivating people to continue to buy. But you also have stimulus talks. I don't see that going anywhere. I've been saying it for a while. I don't think that there's any chance that there's a stimulus deal that's reached. And if it does, it's going to be more of a ceremonial gesture to give people a good feeling rather than any actual substance to it. And then you have constant vaccine news pieces hitting the wires almost on a daily basis. I think the big one this past week was there was like a Russian vaccine. All of a sudden people got excited about it. The news and the media hates Russia almost on a daily basis, but you come out with a vaccine news piece that can rally the markets, then we're going to rally the markets again, and that's pretty much what happened this past week. But enough about that. Let's look at some charts. S&P 500, these are the two main lines that I'm looking at. Yes, they both go back to about March and April time frame. Underneath you have a rising trend line off of April that continues to hold. Now, what I want to see is for price to come back down and retest these levels at some point in the near future. Once it does that, that provides you with a lot better trade setups and a myriad of stocks. And if you look at the price history, it continues to pull back to this particular trend line. And now we're getting a little bit more detached. We're extremely oversold. We're over 90 on the stochastics, as high as 98 at one point this week. So there's a lot to say about there being a pullback right now in the stock market. But maybe we don't get to that point anytime soon. Maybe we continue to keep rallying, and if we do, maybe there's just a pullback to this breakout support level. That's another scenario too. Or if it goes long enough, you could see these two levels converge together and create one solid support level together, at which that would be a perfect opportunity for price to pull back and see a strong bounce. That would probably be the ideal opportunity. But we've got the gap fill going back to February. There's no gaps left to the upside. The only thing really in terms of resistance for the stock market is new all-time highs, and there's been a little bit of a trepidation with price action over the last 3 days dealing with those all-time highs. But as long as we don't see a hard, substantial pullback, I don't think there's anything to worry about at this point, because it's just a matter of coiling, trying to regain its strength before it makes that next push to those new all-time highs that we talked about. Now the Nasdaq has a really nice rising channel here, and it's showing signs that it wants to test the lower channel. Now if it does that, it is absolutely key for the Nasdaq to hold this level. What gives me a little bit of concern though is when you look at charts like Netflix and its rising trend line off of the March lows, it's broken that trend line and it's not showing any desire to really break above it. I'm not sure if this is a sign of things to come in the rest of the FANG stocks or in the Nasdaq itself. However, this trend line had been held in place for a very long time, and Netflix hasn't had any bad news that's come out about it of late. It's just not going anywhere. It's pretty much the only FANG stock that's not doing anything of late outside of Amazon, but Amazon's sitting at all-time highs. Netflix is over 10% off of its all-time highs. Now check out this resistance on the Russell Index. Some really hard, serious resistance here, and it's not breaking above it just yet. In fact, we got a shooting star last week in the Russell. Should we be nervous about the shooting star? Typically, yes, you should be concerned about it, but we've seen the shooting stars on the Nasdaq and the S&P 500, and they have not materialized into any further downside. So I'm not taking it too serious yet until I actually see a weekly candle on the Russell that sees a significant pullback to the downside. But as you can see, heavy resistance, and this resistance goes all the way back to mid 2018. Really heavy, and it tried to break it last week but immediately pulled back hard and fast, and much more faster than any of the other indices. So keep an eye on this, because what we have seen, the relationship between the Russell and the Nasdaq, is when the Russell pulls back, the Nasdaq rallies. That has been a constant theme for the last few months here. Russell weakness results in Nasdaq strength. Now it creates a horrible breadth issues for the market, and that's one of the big red flags right now for me in the stock market, is that the breadth is not there on the rallies. But on the same note, there's not a lot of strong breadth to the downside. You're not seeing 3 to 4 to 1 on declining issues versus advancing issues. Instead, you're only seeing like 1 to 1, and that's not what you want to see on a sell-off. But on the same note, to the upside, the Russell's not participating in the rallies that we're seeing the S&P 500 and the Nasdaq on those particular days. Instead, the Russell lags and it pulls the market internals down with it, like advancing issues against declining issues, or the percentage of stocks trading above their 40-day moving average, which is seriously diverging against the price action that we're seeing in the S&P 500. Now, you probably heard this past week about the Buffett Indicator, and I'll bring it up here just for a quick moment. The Buffett Indicator measures market capitalization against US GDP and against world GDP, both of which are extremely elevated. Right now, market cap to US GDP is at like 130+%. Nasdaq.com bubble got up to 159%. That was extreme. It's extreme right now to be where we're at. I think the only other high reading like that was the .com bubble. Now, when you compare it to the world GDP, anytime it gets over 100%, that becomes a huge red flag for the Warren Buffett Indicator. Right now, it's sitting at 100%. So we should be very, very concerned right now. You've got stocks like Apple, which has doubled its price to earnings ratio over the past year. I mean, this thing historically has stayed in the teens. Now we're in like the 30s on Apple. So it's crazy not to say that we're in a bubble, because when you look at the weekly chart of the Nasdaq, the one bubble that we all agree on was the .com bubble. And that looks like almost like a little tiny blip in history compared to the bubble that we're in right now. Look at 99 and 2000. That was the bubble from the .com. Look at the bubble that we're in right now. Far and wide worse than anything that we saw in the 99 2000. When does it pull back? I don't know. And I'm not trying to call a market top here because I don't do that kind of stuff. What I try to tell you is that, hey, there are conditions that are saying that we are in a market bubble here. Now, do you go full on, let's short everything in sight? No, because the market can stay irrational far longer than you can stay solvent. So you don't step in front of the freight train and start saying, I'm going 100% short here because this is the market top. It can't go any higher, because indeed, when you start saying that stuff, you will find that it does go higher. But what I'm trying to say here is, don't think that what we saw in 1998, 1999, and 2000, the subsequent 3-year sell-off in the Nasdaq, can't happen here in the present day. And a lot of people will say, well, the difference between the 90s and today is that the companies today that are rallying have earnings. Well, let me remind you, companies like Microsoft was the Apple of its day. It was the market darling. It could do no wrong. And guess what? It went all the way up to $54 a share and then sold off to $18 a share. So don't think for a second that Apple, at the very least, couldn't see a pullback from the 400s down into the 300s, or post-split see a stock move from $110 back down to the 90s. It's very possible. It's lunacy not to think that it's not possible. So I'm not trying to say that it's going to go from 400 down to 200 pre-split, or $110 down to like $60 post-split. What I'm trying to tell you to do is be cognizant of the risks that are out there in the market right now, because they are quite elevated. I get that it feels like a risk-free environment, but it's not. Eventually the chickens come home to roost, and you don't want to be sitting on all these profits and let 1 or 2 trades take them all away from you because you didn't manage the risk appropriately. Because when it's all said and done, and when there is a market pullback, whether it's substantial or it's just a moderate pullback, there will be people who will have lost all the profits they have worked so hard for over the course of years, or in the case of the last 5 months, will have lost all of those. Now check out the VIX, and I don't always highlight this in every one of my videos, but this thing has sold off like 8 out of the last 9 weeks, and it's only had 4 weeks in which it's rallied since the market bottom in the S&P 500. But what's interesting is there's this huge choppy support area at around 20. This thing is sitting right above that level, and it's not really breaking down. Now you'll say, Ryan, it's pulled back from the 80s down to the 20s, and yes, that's a significant pullback, but the VIX indicator is a little bit different in that regard, in that over 20 is considered still to be an area of heightened concern for the stock market, where risk is still an issue. And so the Nasdaq's blown past its all-time highs. The S&P 500 is on the cusp of creating new all-time highs. And instead of seeing a VIX that's maybe at like 12 or 13, it's still at 22. That's incredible that we're about to hit all-time highs and the VIX is this elevated still. So keep your eye on it, because it's extremely oversold. It's been oversold for a long time now. Also, and while I have your attention, I just launched channel memberships. Highly encourage you guys to check them out. There's 4 different levels. It doesn't take away from any of the great content that you're receiving on a regular basis here. But if you want a little bit more of an in-depth experience to getting my watch list, getting my additional market updates throughout the week, check out the channel memberships. You can find them by clicking on the join button below. It'll give you more information. So wrapping all this up, what I'm trying to do here is not send you into a panic or into a tizzy to selling everything that you have or anything else. That's not my intentions. What I want you to do is be cognizant of the risk that lies ahead. Yes, the market's rallied far beyond anybody's wildest expectations in the middle of a pandemic and a massive GDP contraction. What I want you to do is always be on guard for when the market starts getting too easy. That's when you should start showing and raising the alarms, because the market's never going to be easy long term. It can be for a period of time, but usually that's at the cusp of something big getting ready to happen. And so make sure that you know where the line in the sand is for you. Where do you get out if things start to hit the fan? Where's that line in the sand that tells you, okay, I'm not going to lose all my profits that I've experienced over the last 5-6 months off of this market rally. Instead, if it crosses this level here on the S&P 500, I'm going to start consolidating. I'm going to start taking profits and positions, because there are periods where the market does pull back. And for many of you, you're getting in at a time where the market has yet to pull back since the March lows, because you've only been in there since the March lows. That's what attracted a lot of people to the stock market, and that's what has a lot of people playing right now. But they're playing the stock market without any true understanding for risk in that regard. If you have any questions, I'd love to hear from you. Shoot them down into the comment section below. What are your plans with this market right now? Are you still heavily tilted to the long side? Do you find yourself taking profits in some of your trades? Or are you loading up and still in margin and saying you only live once, I'm going to keep buying this market higher? Let me know. Thank you. God bless.